I'm Ron DeLegge with ETF Guide TV, and in this episode, I'm going to show you why bonds are not the proper investment tool for protecting the value of your IRA, your 401k, your investments, and other valuables. And I'm going to show you a better approach for managing your portfolio's risk. And then finally, we're going to compare and contrast margin of safety 2.0 versus margin of safety 1.0. Now, before we talk about why bonds are not the proper investment tool for protecting your principal, I think it's important that we first give you the easiest way to implement risk controls inside your investment portfolio. And you'll notice here a 3-bucket approach, which I call the Delegi Framework, for segregating your money into 3 simple buckets. And you'll notice that the margin of safety bucket is labeled number 1. It's right at the top, which means that the prudent investor, which is hopefully you, always takes a safety-first approach toward investing. Yes, your margin of safety comes first. That's where you begin. And then you can get into the other stuff. You don't jump out of an airplane without a parachute and then try to regroup in mid-air. And it's the same with investing. You don't invest 100% of your money and then try to regroup when the market acts up or does things that you didn't expect. Now, if you've already invested without a margin of safety and you're scrambling or you're panicking, well, no need to do any of that. Just keep watching and I'm going to show you what to do. So margin of safety 2.0 versus 1.0, what's the difference? Well, margin of safety is not a new concept in finance. Now, version 1.0 was invented by investing great Benjamin Graham. He applied it to a strategy for picking stocks, which later became known as value investing. Now, there's nothing wrong with version 1.0, but it's crucial that you understand the scope and the scale of version 2.0 is more extensive than 1.0 because 2.0 applies to your entire investment portfolio. It's not just a one-dimensional strategy for picking stocks. What I'm saying is that Ben Graham's original idea of portfolio safety applies to how an investor manages their entire portfolio, not just to how they pick the individual pieces of that portfolio. So what are the 3 attributes of the investments that go into these 3 portfolio parts? So you've got this particular slide which shows you the answer. So if we go to portfolio bucket number 1, that's your margin of safety, you've got principal protection, 0 volatility, and liquidity. And it's important that you understand that you've got to correctly place your investments in the right bucket. If you don't, you're like the person that shows up at the beach in midsummer with snow boots. So again, your margin of safety assets will always meet the minimum standards of safety. That means they have these 3 attributes that we just read off. Your core portfolio is broadly diversified. It invests in core asset classes, and that includes stocks, bonds, real estate, commodities, and cash. Those are the 5 biggies. That's what I teach in my online classes at etfguide.com, which is available to members. You can't buy the classes. You have to first become a free member, then you get access to the classes. But this is the framework I teach. Your non-core portfolio could be under-diversified. It could be high risk, high reward. It can invest in crazy things like cryptocurrencies, NFTs, leveraged ETFs, single stock ETFs, individual stocks, all these things. These are what we call non-core asset classes, baseball cards. So it's important, again, that you understand what type of investments go in which of these buckets. This is the kind of stuff that you look for in a fundamentally sound investment portfolio: core, non-core, and margin of safety. Now, I've seen some instances where some investors just decide to have a core and a margin of safety and no non-core. That's fine. But you're never going to have a fundamentally sound investment portfolio without a margin of safety at all. That's one of the buckets that you cannot get away with. The next thing that we need to help you understand is, and I see this all the time with the investment portfolios that I analyze on my program, Portfolio Makeover, is people attempting to use investments which do not meet the minimum standards of safety. They put these investments or instruments inside their portfolio's margin of safety bucket. Now, here's just a few examples of assets or investments that do not meet the minimum standards of safety. Bitcoin and Ethereum have experienced many, many periods when they've lost half or more of their value. They're definitely not margin of safety assets. Gold is in the same boat. You had a period of 8 years from 2012 to 2020. Gold lost roughly 6% of its value. It's not a margin of safety asset. What about money market funds? Today, there's $5.5 trillion invested in money market mutual funds, and none of that money is truly safe. That's because rising interest rates can damage the value or principal of your money market investments. And then, too, there's the possibility in which your money market fund completely blows up. And we've seen that throughout history. The reserve fund was forced to liquidate and it went out of business, taking $65 billion away with it. It was a meltdown that no one saw coming, no one expected, and people that were using money market mutual funds, like the reserve fund, as their margin of safety, got hurt. And so it's important that you understand that bonds, money market mutual funds are not margin of safety assets. So we're going to focus, though, specifically in this conversation on bonds, because bonds, it's important that you understand that whether it's corporate bonds, municipal bonds, government bonds, and ETFs that invest in these types of assets, and you're owning them, and you're thinking that, well, that's my buffer, that's my safety net. Well, let me show you the next slide of why bonds can and do lose value. And guess what? When stocks go down in value, as they did in 2022, bonds sometimes go down in value too. And if you have an investment portfolio that's all stocks and all bonds and no margin of safety, well, you're going to get hurt. You are going to get hurt when stocks and bonds go down simultaneously. And in this chart, you see that U.S. bonds are down 13% over the past 3 years. That's their worst 3-year return in history. Now, even worse is if you're using your investment portfolio as a primary or supplemental retirement income source. And here's the danger. The combination of falling asset prices plus the withdrawals that you're making on that portfolio, it heightens the possibility of depleting your financial resources. And nobody wants to be that 75-year-old person that's broke because they've depleted their assets. In retirement, your portfolio's balance does not determine your lifestyle. Let me repeat that. In retirement, your portfolio's balance does not determine your lifestyle. It's your income that determines your lifestyle. And if your portfolio takes a massive hit because it lacks an adequate margin of safety, or it's using the wrong types of investments for safety, then a massive unwanted lifestyle change is going to follow. Now, that can mean a lot of things. It can mean less income. It can mean more stress. It can mean being pushed back into the workforce. It can mean being forced to liquidate or sell assets that you don't want to get rid of. See, it's a domino effect when you invest without an adequate margin of safety. And so what is the solution? What can help you? Well, 3 things. You got to calculate, implement, and monitor your portfolio's margin of safety. And if you go to etfguide.com, that margin of safety tool that I built is going to help you to do that. Thank you so much for watching. All of the videos that I'm doing on margin of safety, by the way, you can find them housed and categorized on the playlist labeled Retiring and Investing with an Adequate Margin of Safety right here on ETF Guide TV. Thanks for watching. Don't miss my next episode. We'll see you next time.